Ladies and gentlemen, welcome to the Q2 and H1 FY24 earnings conference call of Elecon Engineering Company Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. Now I hand over the conference to Mr. Prayasvin Patel, Chairman and Managing Director of Elecon Engineering Company Limited. Thank you, and over to you, sir.
Thank you. Good evening and a warm welcome to everyone on our Q2 and H1 FY24 earnings conference call. On the earnings call today, I am joined by my colleagues, Mr. Ayush Shah, Non-Executive Director, Mr. M.M. Nanda, Head of Gear Division, Mr. P.K. Bhasin, Head of MHE Division, Mr. Kamlesh Shah, Group CFO, Mr. Narasimhan Raghunathan, CFO, and Mr. Vrajlal Sanjalia, Head of R&D Department. We have uploaded the press release and earnings presentation on the stock exchanges and the company's website, and I hope everyone had an opportunity to go through the same. I will start with industry and business overview, and then will hand over the call to Kamlesh Shah, our Group CFO, to discuss the financial performance of the company for the quarter and half year ended September 2023. The global economy continues to face challenges and remains under pressure with high interest rates, inflation, and widening geopolitical tensions and uncertainties arising on account of war-type situation in Israel. IMF has revised downwards the global economic growth projection from 3 to 2.9%. India, on the other hand, continues to be on the upswing. The Reserve Bank of India has projected a GDP growth of 6.5%. We believe that India has the potential to surpass these projections, driven by government's increased emphasis on infrastructure development and other initiatives aimed at positioning India as a global manufacturing hub, which presents substantial export opportunities. The capex cycle remains robust, with strong demand across sectors such as power, steel, cement, sugar, etc. Disruptions in international supply chains create an opportunity for Elecon as a reliable supplier during times of crisis. This enables us to foster global relationships, aiding us to achieve our targets. On the note, we are pleased to announce that we have signed off 6 OEM businesses in the overseas market with a total value of 5.5 million euro. We continue to make efforts in building our brand globally and become a preferred supplier offering the widest range and technically competitive products. At Elecon, our primary focus continues to be on research and development and product development to expand our range of offerings. In the last quarter, we introduced 2 new products, the RTC gearbox and screw jack gearbox. The RTC gearbox finds applications in rubber industry and screw jack gearbox in the steel industry, are demonstrating our commitment to exploring new sectors and enhancing value within existing ones. Our team remains dedicated to product enhancements, delivering cutting-edge technological advancements in gear technology. Notably, we have successfully upgraded the crane gearbox as well. These continuous efforts have empowered us to offer high-quality industry-agnostic products tailored to customer preferences while maintaining the shortest lead times in the industry. Moving on to the gear division, we continue to maintain our leadership position in the domestic market, offering industry-agnostic gear solutions. We have experienced a notable uptick in demand with a substantial influx of promising inquiries from both our established customer base and emerging niche sectors. Over the quarter, we have seen this demand getting converted into growing order book. Moving on to MHE division, we continue to deliver robust performance, achieving higher margins quarter by quarter. Our strategic emphasis remains on growth through aftermarket and sale of products in this segment. The order book for MHE remains solid, indicating strong demand driven by ongoing capital expenditure cycle. Lastly, at Elecon, we remain aligned with our vision to maximize value creation for every stratum of society. By aligning our vision with ESG, we have the power to drive positive change, contribute to a more sustainable future, and create long-term value for our stakeholders. With this, I would like to hand over the call to Mr. Kamlesh Shah, our Group CFO, for financial highlights of Q2 and H1 FY24. Over to you, Kamlesh.
Thank you, sir. Good evening, everyone, and a warm welcome to our Q2 and H1 FY24 earnings call. I will now take you through the highlights of financial results for Q2 and H1 FY24. Our consolidated revenue from operations for the quarter ended September 2023 stood at rupees 485 crores as compared to 389 crores in the same quarter of last year, a solid growth of 25% on year-on-year basis. The domestic market accounted for 80% of our revenue, with the remaining portion coming from overseas market. EBITDA for Q2 FY24 stood at rupees 119 crores, growing 28% from Q2 FY23. The EBITDA margin for the quarter stood at 24.5%, owing to better product mix and improved supply chain. PAT margin for Q2 FY24 stood at 18.3% as compared to 16.6% in Q2 FY23, registering a significant improvement of 170 basis points. For half year ended September 2023, consolidated revenue from operations stood at rupees 899 crores, registering a growth of 26% on YOY basis. EBITDA stood at rupees 219 crores, registering a growth of 39% as compared to H1 FY23. The EBITDA margin for the period stood at 24.3%. The PAT for the period stood at rupees 162 crores, a growth of 51% on a YOY basis. Moving on to the segment-wise performance, Gear Division accounted for 87% of the revenue, while 13% was contributed by MHE Division during both Q2 and H1 FY24. Talking about the Gear segment, consolidated revenue from operations stood at rupees 423 crores as compared to 333 crores, a growth of 27%. The revenue for 6 months ended September 23 stood at rupees 784 crores, up by 27% on a YOY basis. The EBIT for the quarter stood at rupees 110 crores, a solid growth of 38% on YOY basis. The EBIT margin for Q2 FY24 stood at 26% as compared to 23.9%, reflecting a substantial improvement of 210 basis points. EBIT for H1 FY24 stood at rupees 199 crore as against rupees 135 crore in H1 FY23, reflecting a growth of 47% YOY. The EBIT margin for the 6 months ended September 2023 stood at 25.4%, registering a growth of 350 basis points. The order intake for H1 FY24 stood at rupees 821 crores, up by 10% on YOY basis. Orders in hand is rupees 615 crores as on 30th September 2023, highlighting the robust demand across sectors. Moving on to the MHE division, revenue for the quarter stood at rupees 62 crores as compared to rupees 55 crores in corresponding quarter last year, growing 12% YOY. Revenue for half year ended September 2023 stood at rupees 116 crore, registering a growth of 18% on YoY basis. EBIT for Q2 FY24 stood at rupees 13 crore, registering a growth of 68% YoY. The EBIT margin stood at 21% as against 14% in Q2 FY23, a substantial improvement of 700 basis points on year-on-year basis. The EBIT margin for the 6 months ended September 2023 stood at 21.8%, an improvement of 920 basis points on YoY basis, primarily on account of better product mix and higher contribution from the after-market segment. The order inflow during the 6 months ended stood at 92 crore as compared to 94 crore in H1 FY23. The open order as on 30th September 2023 stood at rupees 123 crores. Furthermore, our total consolidated order book, including both divisions, experienced order inflows of rupees 913 crore during H1 FY24, and the total open orders as on 30th September 2023 stood at rupees 738 crores. Now highlighting a few developments during the half year ended September 2023. As mentioned previously, we are pleased to announce that we have signed up 6 OEM business agreements in the European market with an annual estimated volume of euro 505 million. The prototype development of this OEM project is currently in progress with the aim of supplying this by Q3 FY24. We anticipate the commencement of commercial production in FY25. The continuous addition of orders from overseas markets is testimony towards our efforts in gaining increased market share in the European market with our high quality, technologically competitive range of products. We continue to make progress in recovering funds through arbitration awards. As of September 30th, 2023, we have received rupees 30.9 crore out of the total awards of rupees 63 crores, and we expect an additional realization of rupees 1 crore in October 2023. Negotiations are going on for the remaining amount. Furthermore, we have initiated fresh arbitration proceedings with a total value of 31 crores during Q1 FY24, outcome of which may take 1 to 2 years. We are confident of a positive outcome. I would also like to highlight that the operating cash flow from operations after payment of taxes stood at rupees 180 crores as at 30 September 2023. Lastly, we are dedicated to increase our market share through expansion into new territories and further strengthening our presence in existing ones. We have set a revenue target of 2,000 crore for FY24, and we would like to highlight that this is achievable. Further, deterioration in ongoing geopolitical uncertainties and tensions may lead to potential spillover of the orders to next year. When it comes to the margins and profitability, we anticipate that the same will surpass our guided margins. This will be driven by various factors, including improved operating leverage and an enhanced product mix. On this note, I would like to open the floor for question and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Participants present on the bridge who wish to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pratik Kothari from Unique PMS. Please go ahead.
Hi, congratulations and thank you for the opportunity. So my first question is on the engineering gears piece and the international side of it. If you can just highlight what are the developments that we seem to be in this range of 1,800 crores for past few quarters. So, and also we do hear about the challenges in the European and the US markets. If you can just highlight where we are, what are we doing to improve, just some qualitative aspects for our international subsidiaries.
First of all, hello to you, Pradeep. We at Elecon, as you know, we have our foreign subsidiaries through which we are trying to market our products. And we have started to see a great activity as long as our marketing setup are concerned. They have gone ahead and made a lot of agreements with various OEMs. Apart from this, we are trying to enhance our distribution network and to see to it that we are able to market our products more extensively and get to a deeper reach. As long as our strategy is concerned, we are forming an entire group which is going to evaluate and make the necessary improvements and enhancements which are required. We will go and recruit more foot soldiers or manpower to further enhance our reach, as well as enhance our dealers and distributor network. This is on the offing, and I'm sure that this will produce very good results. On the other hand, we are confident that this year we will be able to achieve our export targets, and going further, we would be able to grow at a high percentage in the coming years.
Correct. So despite the bleak environment, demand environment that we keep hearing and reading about, we are confident that in terms of, I mean, we are seeing enough opportunities out there because we are very small in international markets. So I believe this will all be market share gain that we intend to do. So despite the bleak things that we keep reading about, I mean, we are confident that it's prudent for us to go out and capture those market shares.
There are various reasons for it. One of the reasons is, first of all, we are cost competitive. Since the environment internationally is getting to be more and more challenging with recession and recession kind of environment in the international market, every client, as we observe, is looking for alternative suppliers who are competent and who have got a vast experience like us. And therefore, we see a great opportunity in this time of crisis.
Right. That's good to hear. So my second question is on the MHE. I mean, we are reading a lot about the push on Indian infrastructure, mining, Coal India, Indian Railways. So I mean, we have had a slightly rough experience maybe 10 years back in MHE, but given the opportunity or landscape that maybe we can, at least what we are reading for the next 3, 5, 10 years, just if you can highlight what is our preparation, any positive surprises possible there. I mean, I'm sure we'll be cautious going ahead, but how do we also ensure that we capture the demand which might come?
See, right now, as you are aware, we have recently got an order for approximately 50 crores coming in from the steel industry. Going forward, the steel industry and the power sector both have got great potential to give us large number of orders, and therefore we are trying to associate ourselves with companies so that we can supply our products but not get into project execution, because that is where one tends to falter over a period of time. And therefore, we are seeing that there is a vast potential to supply our products to a lot of companies, and we are trying our utmost to do that. We are confident that you will hear a few orders which we would bag very shortly. Okay. We are in active discussion with a lot of our clients, whereby we would be awarded a few orders.
Correct. Fine. And one question to Kamlesh, if you can highlight what were the export numbers from our standalone business, and Also, any one-off or other income, we have seen a sharp jump in that. So anything if you can break down.
In regard to the other income, yes, we have one-off kind of item that is related to the insurance claim. So last year there was a fire incident in April 2022 for which we have received the insurance claim. So excess of my written down value of the asset is considered as other income. Plus we also have one profit on sale of asset also. So that is also there, which is to the tune of 3 crore. Both put together is nearly 5.7. You can consider rounding of 6 crore of that amount. And in regard to the exports from India, so this quarter we had an export of 20 crore, and for H1 both put together is 42 crore. So there was spillover of our order for the execution, which is coming in Q3. And also due to the Ind AS, because under the Ind AS there is a specification for the recognition of revenue, under which the revenue recognition to the tune of nearly 20 crore will be considered in Q3 FY 2020.
Correct. Sir, thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Akash from Dalal and Broacha Stock Broking. Please go ahead. Akash, your line is unmuted. Please go ahead.
Yeah, sir. Thanks for the opportunity and congrats on taking the great set of numbers this quarter. So, my first question is on the capacity utilization this quarter, sir. How is that been?
Present our capacity utilization for the half year ended 30th September 2023 is 76%.
76%. And what is the scope for, what would be peak utilization?
What's possible? We can do up to 85 to, if you have to stretch, I can go up to 90. But some of the capacity I have to keep spare for my, R&D development and other upgradation also.
Correct. So, okay, sir. Yeah. And my second question was, sir, in the gears division, if you could provide us with a split on the mix, that is how many standard gears and how many engineered gears have you supplied?
Yeah. For the quarter ended for the half year 2024, that is September, my catalog product amounts to 45% of my revenue, and engineer product is 55%. So this time, you can see there is a reverse trend where the engineer product is high and catalog product is, we are more focusing on the engineer product.
So okay, so in the Q1 it was more of catalog, is it? In Q2 it's more engineered.
Yeah, in Q1 it was nearly 48% was from catalog. 52% was from catalog and 48% from EP, engineer product.
Got it, sir. And any ballpark realization per ton we would be achieving in what would be the realization per ton in both these divisions?
Yeah, I can't get you what you mean to say.
Yeah. So, what would be our realization per ton of metal in both these divisions, the catalog and the engineered product?
I think that kind of figure we don't have because, we have the product as having the weight of 1 to 2 kg, and we have the product having the weight of 80 ton per gearbox also. So we have
maybe per kg revenue realization in both divisions, if you have any number.
I'll keep a note of that and I'll circulate it through SGA to you, if you don't like this.
Yeah. Thanks a lot, sir. And good luck.
Thank you.
Thank you. The next question is from the line of Mahesh Bendre from LIC Mutual Fund. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Sir, in the first half, we have grown by 26%. And just to meet our guidance of FY24 of 2,000 crore revenue, we need to grow by 35% in the second half. Now, the current situation, the business environment both in India and globally is slowing down. So, will we be able to hold on the numbers that we have been talking for that?
The orders that we have on hand and based on the trend that we see, we feel that there is a very high possibility that we will be achieving our numbers. Only under tremendous harsh situations or bad situations in the environment, the political and commercial and economic environment, that we feel we may not be able to achieve. Otherwise, the probability is very, very high that we will achieve them.
Okay. And sir, we are in the month of October now, and for next year, given the order book and the new OEMs that we have signed in, any view on the growth prospects in FY24 in terms of sales growth?
We will be evaluating the situation since the geopolitical situation right now is very tricky. Internationally, we will evaluate the situation in the third and fourth quarter and then come up with our figures.
Sure.
For the next year.
Sure, sir. And last question from my end, sir. We are operating now 74% utilization now. So, what are the plans for a capex for capital enhancement?
There is a continuous capex that we are doing. And apart from that, we have to also understand that by outsourcing, we still have a very high potential to go through. Because right now our outsourcing is fairly limited, and if we enhance that, the potential would be much, much higher.
Sure. Thank you so much, sir.
So we are on track so far the capex is concerned, and we are just evaluating the geopolitical scenario, how it is, how it is spreading out or how it is going to be going forward. And accordingly, we just take a call for further capex if required.
Sure, sir. Thank you so much.
Thank you, Maheshji.
Thank you. The next question is from the line of Aditya Rathi from Equitas Investments. Please go ahead.
Hello. Thank you for the opportunity, sir. I wanted to, sir, just check on the overseas exports that we have, and I see that there has been a sharp decline in that. In the current year, quarter 2, I see that only 20% of the total revenue comes from export. And if we see historically, it was close to 30%. So, sir, when do we see the recovery of it, and what's the main reason behind it?
As I already discussed a while ago, because nearly 20 crore of my sales revenue, it is deferred to Q3 under the India's accounting policy for revenue recognition. So that is
okay.
And some orders it got spilled over to Q3 for the execution, of which the dispatch has happened in October.
Sir, what kind of dispatch happened recently?
Pardon?
Sir, what was the last line? I just couldn't hear it.
My order execution is
right.
that dispatch has happened in October.
Okay.
Let me explain it to you in other terms. There are some orders which have a longer lead items, and therefore the lead times, and therefore it takes a longer time for deliveries, and therefore some of the deliveries will take place in this quarter, and therefore the figures are not looking attractive right now, but they will even out by the end of the year.
Okay, sure. Thank you, sir. And so the other question, the 5.5 million annual revenue that we have mentioned from the 6 OEM internationally, so are these already included in the order book, and when will it materialize?
No, it is not included so far as in this order because we have signed off and the prototype is under development. So once the prototype gets clear, then the formal order with the volume will come, and that we already spelled out. It will be in FY25.
Okay, perfect. Sir, next question comes from the cash generation point of view. I think we already have close to 350 crore odd cash, and with the future prospect of company's guidance, I see that there's going to be a pile of cash this year also. Sir, any mindset of utilization of this cash?
As of now, we are looking at various prospects, evaluating, and as and when we feel that there is a right opportunity for your company to invest this cash for expansion, diversification, or for acquisition, at that time we will consider it.
Okay, sir. So nothing as of now that you've thought of?
No.
Okay. And so my last question comes from the recent contract that you have given as an announcement from Arsenal and Nippon Steel of 50 crores. Sir, that belongs to energy division, and if I'm not wrong, that is an EPC contract, right?
It is not an EPC contract. The order that we have received is from ArcelorMittal. This order is for material handling and will be executed over a period of time.
Okay. Thank you, sir. That's it from my end. Thank you so much.
It's supply of equipment only. It is supervision of installation commissioning.
Thank you. The next question is from the line of Sahil Karia from White Pine Investment Management Private Limited. Please go ahead.
Yeah, thank you. I'm Neeraj Mansinga. Actually, two questions. One, on the contract announced by ArcelorMittal Nippon Steel India on the pipe conveyor system. Can you give some color on the industry? And because what we understand is that the pipe conveyor system has a large potential in India. So how are you placed among all the competition in India, and how do you see the business environment over the next 3-4 years?
As such, pipe conveyors has a great potential. We have executed pipe conveyor systems in the past. Right now we have this order, and as and wherever that we get an opportunity where the client requires a pipe conveyor, we have been offering these. And overall, not only in the steel industry, but also in cement and power, there is a great potential for this.
Are you also applying for the conveyor systems for Coal India and other minerals in India?
I'm sorry, I didn't.
Are you also trying to work for Coal India for making conveyor systems for them?
As you know, we are trying to see to it that we do not get into project orders, but as long as conveyor systems where products are to be sold, we are trying our utmost, and also with Coal India.
Got it. So the second question is on the 6 OEMs which you have given 5.5 million euro. Can you give us some color how large they can become after these supplies that can be there? What is the potential that you see in these OEMs?
The potential is large. It is difficult to equate it because it will all depend on how many orders our OEMs will get in the future. But these prototypes are in development, and once they get developed, the commitments are reasonably attractive by the customers of ours to enhance the requirement.
So these all are the prototypes, right? These are all the 6 OEMs.
Right now we are on the verge of supplying these prototypes to them, after which they will be tested by them, and then they will place orders on us.
And this, when do you expect, if any order comes up, scale up on this side, when do you expect these orders to flow to you?
We believe that by FY24, we will see the first few orders coming in.
Great. Thank you, sir.
Thank you. A reminder to participants who wish to ask questions may please press star one at this time. The next question is from the line of Mudit Kabra from Elara Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. I have a few questions. Firstly, can you give us the recent number for market share in industrial transmission gas?
Sorry, can you repeat your question, please?
Sir, can you give the recent numbers for market share in domestic industrial transmission gas business?
Our market share in India as a market is 39% as of now in the organized sector.
Okay, thank you. And secondly, sir, any specific reason for decline in inflows across both the segments? Any specific countries or any specific regions where decline is pretty evident?
I'm sorry, I can't hear you properly.
Your voice is not getting
distorted.
Hello, sir. Is it better now?
Still, it is the same.
Yeah, if you speak a little bit away from the microphone, it might be better.
Okay. Sir, any specific reason for decline in inflows across both the segments?
I'm sorry?
Declining?
Sir, decline in inflows in Q2 across material handling and transmission gas.
No, there is no such decline what you are just referring to, because we don't foresee about that. That's what we have given our guidance that, our 2,000 crore guidance of revenue will still sustain for us. And
see, there is no decline in order inflow.
Okay.
So, the numbers are attractive, and we believe that if this flow continues in the same way, our targets will definitely be met with.
Okay. Okay. Sir, and lastly, any development on the new product range we were planning in the rail and metro segment? Any timeline we can hold on to it?
As of now, it is difficult to give an answer, but we are pursuing with the OEMs who are supplying in the rail and metro, and we will see over a period of time what materializes.
Okay, sir. Got it. Thank you.
Thank you. The next question is from the line of Anish Jobalia from Girik Capital. Please go ahead.
Hi, sir. Good evening. I hope I'm audible. So just one question around the margin side. So Q1Q, we saw also an expansion of the margins. So just wanted to understand this 24.5 at the consolidated level. In case I have missed the commentary, if you can just help to understand how sustainable are these numbers. And I think one thing our endeavor was to, reinvest back into the, the business development on the international side. So has the investments already happening, and what stage of the investment, we are going forward, this is likely to increase. So will the margins, start tapering down from the current levels?
The margin, yes. Now, after the Q2 results, we are confident that this margin will be sustainable. However, it all depends upon the product mix, so that is important for us. Second, so far the investment is concerned, that investment was, when we discussed earlier, it was in the form of strengthening our business development team in the overseas entities, and also on the brand building and the digital marketing efforts. We have initiated that, that effort. But substantial portion of the amount will get invested or spent maybe in the Q4 or the early next year on that.
Okay, so is it that we are still not spending aggressively because of the global uncertainty, because of which we are deferring that spend, and that is why we are seeing very high margins of 24.5, given that earlier we were only expecting 22%. So, how do we see the trend moving? Like, in the next 2 quarters, we can continue to expect this 24.5% margins,
We will have that healthy margin compared to what we have given the guidance earlier at the beginning of the year. So margin will definitely improve. However, the spend what we planned earlier, we are not going with the same plan for spending on both business development and strengthening the business development team, and also on the digital marketing and brand building. So we are just going cautious on that, and considering the current geopolitical scenarios also, we are going slow on that spending.
Okay, sir. Thanks. All the very best for the next 2 quarters.
Thank you.
Thank you. The next question is from the line of Gunjan Kabra from Niveshaay. Please go ahead.
Hello, sir. Thank you for the opportunity and congratulations to the team for a great set of results. So my first question was that in the presentation it's mentioned that when you say in the cement industry, there's a shift towards the roller press gearbox and the Elecon is the only player. So I wanted to understand, will there be a replacement demand as well from on the current capacity installed in the cement plants, or it's just for the new expansion will be in this type of gearbox?
I would say the potential is there for both. It is for replacement as well as for new requirements.
So what kind of an opportunity size that can be, and are you also gaining traction from the replacement demand right now, or is it still at a very nascent stage?
It is at the initial stage right now, and it is difficult to conceptualize what would be the potential.
Okay, got it. Sir, also, if suppose that it's mentioned that 3 thermal power plants are expected to come up. So I wanted to understand if there is a thermal power plant being set up, say for example, 50 megawatts, for example, then what's the share of the order size that we get in the gear box? I mean, of the total expenditure that is incurred. So what's the percentage or what's the amount that we get for, say, example, 50 megawatts? Likewise, if you can highlight an FGD also, if somebody is setting up a 10 megawatts or a 50 megawatt plant, then what kind of an order size do we get from there?
It all depends on what percentage of orders go to the subcontractors, and based on that, how many gears are converted. It's very difficult to put a number to it, but I would say it is even less than 1%.
Less than 1%. Okay. And so going forward, which are the major sectors that you think right now, 22% is coming from steel industry. So going forward in terms of order inflow trend, so which are the sectors you think where you expect to receive sizable orders?
We are seeing a good traction in cement and power, apart from steel, and these would continue. The sugar cycle has just been completed, for this calendar year. And so the traction will start from beginning of next year for the next year. There is also a high potential in the sugar industry, especially for the manufacturing ethanol as a fuel.
Okay, got it. Sir, also, if you can highlight, it will be great if you can highlight the percentage of engineered gears in the total order book versus the standard gears in the current total order book of around 615 crores. So what's the percentage of engineered goods and standard goods?
I don't have that figure as on today on the open order book, what is the portion of the engineer product and the catalog product. But on the revenue side, what it is there for for H1 2024, 45% is from catalog product and 55% from engineer product. So I'll just keep a note of that, and I'll just reply this to SG, our investor partner.
Sure, sir. It will be of great help. Sir, also wanted to understand that in the opening commentary, you mentioned that, there is supply chain disruptions in the global world, and Elecon is standing to gain some advantage also. So wanted to understand, like, during COVID, there was this freight and material disruption that people could not transport materials. So right now, what's the kind of, supply chain disruption that we are facing in terms of maybe, the players have they have shut down some facility, or there is less supply in the overall gear market, or in terms of materials or cost? What is the, what's the supply chain disruption that is happening in the gear business right now at this moment?
Yeah. The Russia-Ukraine war is one reason why there could be disruptions, because the energy cost, especially in the European market, has substantially increased, and a lot of industries have closed down because of that. Apart from that, there are new challenges now with the Israeli war on the anvil. So these are the reasons why quite often there is either excessive orders or a tremendous shortage of a particular item, which can cause a lot of disruptions. So going forward, it is difficult to put our finger exactly as to where the problem would lie. But as far as our supplies are concerned, we see it as a great opportunity, because the European-based companies would find it difficult and tough to execute orders, and whereby we would be at a relative advantage in those conditions.
Okay. So just to follow up to this, so what kind of problems can we see in the with the Israel war?
Ms. Kunjan, sorry to interrupt, but may we request that you return to the question queue for the follow-up questions, as there are several participants waiting for their turn.
Okay, thank you so much. Not an issue. I'll get back.
Sorry.
No problem. So, ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference call, please limit your questions to 2 per participant. Should you have any follow-up questions, you can rejoin the queue. The next question is from the line of Anika Mittal from Invest Analytics Advisory LLP. Please go ahead. Ms. Mittal, your line is unmuted. Please go ahead.
Hello? Hello. Am I audible, sir?
Yeah.
Good evening, sir. Congratulations on the good set of numbers, sir. All of my questions have been answered. Just one question, sir. Even if going ahead, we don't get business from new customers, how confident are we to achieve their revenue guidance? And going by that, can we assume our H2 will be way better than H1?
Can you please repeat your question? It is we are not able to hear properly.
Sure, sir. So I am asking, even if going ahead, we don't get business from new customers, how confident are we to achieve the revenue guidance? And going by that, can we assume our H2 will be way better than
H1? What I would like to tell you is, normally 70% of our customers are repetitive. Okay. This is what the history says, and considering that and the present order booking that we have, we see we are reasonably confident, or I would say highly confident, that we will be able to achieve our numbers for FY24.
And if you see, our H2 is always better than H1, historically also.
Okay. Thank you, sir. And congratulations, sir. Thank you.
Thank you.
Thank you so much. The next question is from the line of Harshit Kapadia from Elara Capital. Please go ahead.
Yeah, hi. Congratulations, sir, on a good set of results. So a couple of questions from my side on in terms of order inflow. We have seen some deceleration in the growth in order inflow. Now, is that something which worries you at this point in time, or there are plenty of orders in the market, but because of probably geopolitical situation, things are not moving at the pace, or is it that up to run up to election, things are just being little bit delayed? Your view on that?
Basically, we are happy with the order inflow. Apart from that, we see that the inquiry numbers are reasonably healthy going forward. Quite often, there are projects which some or the other take time to get converted into orders. And therefore, we are at a juncture right now where we believe that there will be flow of orders coming through in the next quarter or so.
And this would be largely related to power sector. Would that be a correct understanding? Or which sector would you say where you see some amount of softness?
It is in general. We have not figured out whether it would be from power, steel, or cement. But in general, quite often the projects take some time to get converted into orders. So we are reasonably confident from the inquiry levels that we have that these orders will materialize very soon.
Understood, sir. Second question on the exports front, sir. We were trying to, create a lot of business from the exports, especially Europe was our target market. You also got a few orders in Q1. So if you can highlight how is the pipeline in Europe, and is there the current war, which is it hampering any kind of a business to you or delaying some decisions there? How do you see that?
As I told you, there is a big thrust from the management to enhance our exports, and we are continuing with our strategy. We believe that over a period of time, this will bear substantial fruits going further ahead. Right now, it seems that it is taking a little bit more time to take traction, but I believe that going in the next 12 to 24 months, you will see that it has further got enhanced to a large extent.
So presently, what is the share of exports from a total revenue, and where do you think, let's say, 2 years down the line, that you see exports to be a bigger part? If you can share some numbers, that would be helpful.
Presently, our 23% revenue is from export and overseas businesses, and going forward into that's what it is difficult for us to give a numbers down the line, but we are working upon the same, and what we already discussed about our target for FY30 of reaching to 50% of revenue from the overseas and the export business. We are working on that, and we are confident to achieve that also.
Okay. And so lastly, on the material handling equipment side of your business, sir, if you can share some insights in terms of how has been the first half and how do you expect the order momentum on the material handling side to see over the next year, it would be helpful.
Yes, as you already seen that in October itself, we have got the order for nearly 51 crore from a steel industry, which is only, this is related to supply of equipment only, supply of equipment and installation of our equipment only. And the same traction will continue. Team is working, and they are quite confident, by the end of this year, there will be a good news will come from the growth perspective of MHOs.
Okay. And last question on the margins, sir. You still maintain the EBITDA margin around 22% for this year, or is there any scope of a rise from this number?
Now, I think with the results of Q2 and H1, we are confident that we sustain the margin what we already declared now, or even improve upon it.
Okay. Congratulations, and wishing you all the best, sir. Thank you.
Thank you.
Thank you very much.
Thank you. The next question is from the line of Satardu Chakraborty from Chakraborty Family Office. Please go ahead.
Good evening. Congratulations on a good set of numbers. I will just ask one question, what I see in slide 13 around the Eon 2 series. I'm very happy to see we put a point around operations condition monitoring. So my question really is, what is your vision, Mr. Patel, of having this sort of digitalization in each and every gearbox, and how does Elecon plan to sort of capture this opportunity? Because I can imagine that if you have a continuous SCADA system, then these digital systems are very helpful. Most customers are wanting that. And probably it is fair to assume that the margins are much better on these kinds of gearboxes.
Today, what is happening is you want a gearbox which is extremely reliable and which works trouble-free for years together. But apart from that, one also has to consider the fact that it is a mechanical product which goes through wear and tear, and quite often there are hiccups because of exceeding the torque or power requirements. Under those circumstances, it is always better to monitor a particular gearbox, or I would say all the gearboxes, and therefore the intention is that if we can provide an economical solution for monitoring the various parameters of the gearbox and supply it with the gearbox itself, so that the maintenance people can monitor the gearbox through their mobile phone and are able to get warning signals in case of the limits exceeding the values which could be critical to the gearbox. So the intention is to come up with a system which is not very expensive, so that the client can afford it, and put it up in various gearbox so that one is able to monitor them and create data which will also help in preventive maintenance. So this is the intention, and we are considering this very, very seriously, and have done a reasonable amount of work on it.
All right. Thank you. All the very best.
Thank you.
Thank you so much. The next question is from the line of Ankit Bavel from Shubhkam Ventures. Please go ahead.
Good evening, sir, and congrats for a good set of numbers. Sir, two questions. First, you mentioned that the current level of operating margins are sustainable going forward. So is it fair to assume that such margins are sustainable even in the next couple of years point of view?
Yeah, that we can't comment at this. But yeah, our margin is expected to be better than the guidance, even going forward also. But yeah, sometimes due to the change in the revenue mix, the margin may improve, and or either it will remain at the sustainable level.
Okay, so the new range we should work is in the range of 24% plus at operating levels for next year and going forward, right?
At least 23% plus you can consider going forward from the next year.
Okay.
And this all depends on the product mix. That's what I say. Any change in the product mix will definitely improve upon.
So more share of engineered products will only improve the margins, right? Is it fair to assume?
Engineered product, after sales, those kind of things.
Okay. And so my second question is, again, now we are already in the month of October, November. So, this year guidance you have given at around 2,000 crores revenue. Any idea about the next year revenues, what you are targeting, given the fact that you are signing up, new customers from Europe and other overseas countries? So what kind of revenue trajectory you look next year, sir?
Ankit, I think we are working about that, and presently due to this geopolitical scenario, how it is disrupting the, entire economies, and, drying up the US dollars in the various economies. We also are evaluating those, and I think it would be right for us to, instead of telling the numbers now, Q3 would be the right time for us to at least work out and, spell out some numbers about that.
Okay. Fair enough. Just a follow-up on the first question, sir, on the margin front. Now, this 23 to 24% range will sustain even considering the fact that the share of these new overseas contracts will increase, because as you had mentioned earlier, that you'll have to invest also a lot in this first, for branding and all those, and the margins would be lower. So even after considering the fact that the contribution from these new customers will increase going forward, you still feel that the margins will be in the range of 23 to 24%.
Yeah, at least 23% plus is definitely sustainable. And that is where our, supply chain management team is working to at least optimize the overall margin for us.
Okay. Great, sir. Thank you so much.
Thank you, Ankit.
Thank you.
Thank you so much. Well, we would take that as our last question. I now hand the conference over to the management for closing comments.
Thank you everyone for attending this call. If you have any more questions, you can either contact SGA, who is our investor relations company, or our CFO, Narasimhan Raghunathan. Thank you.
Thank you. On behalf of Elecon Engineering Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.